Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, look at some information that's going on there. That's kind of where I look. I'll give you my financial opinions on everything here. A lot of the times I don't really focus too much on the news. I just kind of look at it and use it as entertainment. I look at the structural deficits in the market, and those structural deficits, for the most part, need to be solved by supply side solutions. If the demand comes down, that's generally temporary. And what I mean by temporary, it could last for 6 months, it could last for a year or two at most. Sometimes, some people call that a recession, a slowdown. And as these markets move, they are dynamic too, because we had shutdowns around the world that happened and occurred at different times, and they reopened at different times. And that's going to put, I'll say, demand pressures on certain supplies differently. So it's not as easy as looking at history, seeing a flat kind of demand steadily increase. We get these sharp movements lower when things are locked down, and then when they open up, you get these gigantic demand increases. So comparing it to history is a little bit more difficult than it is now, just because you've got those closings before and then the reopenings after. And China just reopened, and I think that we could see a lot more demand coming from China. And that's generally when we reopened, especially in America, there was a demand. We had supply chain shortages and all sorts of stuff going on because the demand overwhelmed everything. So I think that's probably going to happen in China as well. And it takes a little bit of time to get moving. We reopened, shortly thereafter. Was it probably like April, May of 2020, and things really heated up in 2021. So it took, I'd say, 6 months to a year to really get moving. But let's dive in here. Let's see what's going on. And again, if you guys want to follow me, it's at finding_finance on Twitter. So let's look. It says inflation expectations being well anchored has been a comment retort in response to the idea that the Fed is behind the curve. Well, the 10-year break-evens are back to 2.52%. The 5 years at 2.71. That's a lot less anchored. Will the Fed care? Now, let me go into this thread here. I think he's got a thread on this. Yep. It says, anyone who thinks the Fed is in control needs to read Apollo's presentation this week on the housing market. It was featured in the FT this week as well below. The Fed can't stop animal spirits easily after letting them run hot in 21-22. I wish it were that easy to fix. It's not. It says, has the U.S. property markets turned already? And he's got, obviously, the bull market and housing. It says also, China's finally reopening, and two, artificial pressures on the oil market from the U.S. SPR draws are now likely in the rearview mirror. Autos, housing, retail sales, and oil all likely stronger sequentially. Services not cooling off to offset. 23 will be interesting. And this is your strategic petroleum reserves falling off a cliff that we used. What does that mean? Well, I think the government and the Federal Reserve, they got scared by how much inflation could have been created. Oil's the mechanism that transfers that inflation into the consumer price index and into goods and services. What did they do? Well, just dump oil on the market, and we could probably push oil price down for a while. Now we've got that much less inventory of oil. And when we run into the situation where the supply isn't solved, we're going to see how high oil can go. And it could go very high. So scrolling back down, it says, ouch, the value of global bonds has plunged by another 550 billion this week. This brings the total bond losses over the past 5 weeks to 2.4 trillion. All gains since the beginning of the year have been wiped out now. Now, I was just looking at the chart here. This does look like a inverted head. Here's a shoulder, a head, and a shoulder. So it does look like an inverted head and shoulders, perhaps. And if it is, that means that this will go higher and that we could see lower interest rates. It's a possibility. But I wanted to share that just by looking at the chart there. We've already covered that. We've got, what are some of the most common mistakes people make when trying to build wealth? I wanted to make some comments on this about building wealth. And obviously, you can build wealth through multiple ways. And there's multiple wealths, so to speak. One is financial wealth. One is the health of the person. And obviously, you're not going to be wealthy if you don't have any health. I mean, if you don't have health, you're just going to be miserable, not being able to do something, or having problems with your health. It's going to suck all your money too. So that's one thing. But here's some problems about wealth. A lot of people who they think they don't have a lot of money, and I don't know what size portfolio that is or whatever it's going to be. They think they have to take on a whole bunch of risk. They want to grow their wealth and like, it's not a lot of money. Who cares? And I'm going to try to grow it as fast as possible. I don't think that's the right approach or the right paradigm to look at it. If you don't have a lot of money and you can't generate a lot of money, then you have to be protective of it. You want to find really good situations from investments that have gigantic risk rewards that also have high probabilities of success. Portfolio allocation becomes incredibly important, and you really want to make sure that you're hitting those base hits wherever you can get them and making sure you're progressing that forward. Now, some people think if you've got more money or more wealth that you can kind of take on more risk. At some point, you can a little bit. You can really swing for the fence with a small portion of your money. But if you don't have a lot of money and you're trying to build wealth, I think there's ways that you're going to have to put it in your control. So if you really want to get rich quick, you're going to have to do whatever you can that's fully in your control. What does that mean? Building a business. Finding a career that you can make a lot of money. Those have high probabilities of success because you have more control over it. So if you were to go to school, become an engineer, maybe you'll make more money doing that than you would working at McDonald's. If you can do that. And you have full control over that. You'll have more control if you buy a house, rent out the 3 rooms. Let's say you've got a 4-bedroom house. You live in one of them, you rent the other 3 out, you collect rent. Effectively, you're increasing your income. 2, you're reducing your cost of living. You can do certain things like that to build wealth over time for a period of time. You can get a side gig. You have control over the side gig, and it brings in income. You could create a YouTube channel. Whatever it is. I think what happens is a lot of people, they think they're going to create wealth or build wealth. They take on far too much risk in stuff that has low probabilities of success that they have no control over. The stock market, we don't have control over that. You're at whatever the stock market's going to do. You're at whatever these humans in the herd's going to eventually give you. And if you're in an investment that doesn't really, let's just say it's a very highly speculative, small little junior company, I mean, the risk there is very high and it may not pan out the way you want it. And the worst thing that can happen is we go into a gigantic bull market and the stock that you're in doesn't do anything. That's a real big kick to the nuts. So I just kind of wanted to cover that. And the way that I built wealth is I'm an engineer by trade, and I moved up a little bit in that world of things, in the big corporate world, which I don't like it either. But I just kept savings and invest, and was really patient with everything. That's kind of how I did it. This is a story in 3 parts. So let's look at this guy. The second half of 21, CPI is greater than 5.5%, but transitory. Fed not doing much. The first half of 22, CPI is at 7%. Biden's approval rating is tanking. He tells Powell to fix it publicly. Fed goes hard. In fourth quarter 22-23, CPI is greater than 6%, but not in the news much. Polls okay, Fed is backing off. The causal variable. says the 12-month inflation rate in the United States from January to, so this is your inflation rate. And you can see this thing take off. And, keep this in mind because we just reopened in China. And I think China is going to have a similar type of movement as this. It's going to start off kind of slow, and then it's going to pick up in about 6 months to a year is where it's really going to start to pick up. So when you're thinking about commodity prices, you're going to have to be a little bit patient if you're banking on the reopening of China. Coming on down, it says, maybe data dependency is just Biden's approval rating. It troughed coincident with peak CPI. He got the message and started draining the SPR. Now he's retraced back to baseline. Fed can take their time. I'm not sure this material, but hard to understand the Fed absent this. This is Joe Biden and his disapproval rate and how it's gone up and how the approval and disapproval rates have moved in relationship to inflation. Coming on down, it says oil. U.S. oil is breaking out. So he took a basic trend line, hit it down, and it's starting to move on up to the upside. Is this the breakout that we're waiting for? Maybe. To me, this looks like a accumulation cylinder. It's 1, 2, 3, 4, 5. The double top, Batman top, comes down an ABC correction. We're kind of consolidating a little bit, and we'll eventually see our move higher, hopefully. But it's looking better. He says, is the inflation momentum back before it even disappeared? Look at the Chinese credit impulse versus the ISM service prices. Looks extremely bad for the second half of 2023. So this is the Chinese leads the global price cycle. And you can see Chinese credit float through to price with a time lag. This is already heading higher for the Chinese credit. And this is where prices, I think, will eventually move in 2023. That's your oil price, your commodity prices, all that stuff. So I do think it is coming. Let's check out the thread real quick. It says, we've released our inflation watch with 5 pros and 5 cons and expecting another top in inflation. It says that hints to flat ISM prices. Correct me if I'm wrong. It says they have adjusted. Yeah, we'll go back here. We already went through that. So here's natural gas. So oil versus natural gas ratio. Both moving higher. Only difference is nat gas is flying. As mentioned, lucky me, few. And here it is at a very high ratio. We got all the way to about 36 almost. And we're starting to come on down in the free fall zone where we can compress natural gas against oil, which means natural gas could outperform oil. And we should be looking at natural gas companies because of the ratio being so incredibly cheap against everything else. Natural gas, huge buy in my opinion, where it's at. So about $90 WTI by the end of September, I'll take it, is what he is expecting. This is looking at the seasonality of this and how we're here and how we're going to head on up to the top there for oil. And we've got that breakout. So I'll kind of end it there. That's what we've got for today. And lots of good information. Natural gas is looking really good. Energy service companies are looking really good. I think the forgotten uranium sector, that could really move here shortly as well. I talk a lot about it. We look at a lot of companies. Some of these companies have incredibly good entry points. They've got the Livermore accumulation cylinder. I see it all over the place. We see it in uranium companies. We're starting to see it in small cap oil companies. So a lot of good opportunities out there. We've got our entry points coming up. I'm sharing them all on the website, finding-value.com. I talk about them during our platinum question and answer sessions and our midweek updates that we have. So if you're not a member, check it out. You can use the word discount in the coupon code to get yourself a discount. You can check it out and try it out. That's all I've got. Give me a thumbs up for the content. Subscribe to the channel. We'll catch you next time. This is Finding Value.